Good morning. Ever stepped on a Lego at 3 a.m.? Parenting is not for the weak. When it comes to dressing kids, Carter's makes it so much easier. Carter's is the #1 children's apparel brand in North America, known for keeping babies cozy and parents' wallets a lot less traumatized. Sounds like a great investment, correct? Not so fast. Let me introduce myself. My name is Brian Smith, or as my little ones like to call me, Paw Paw. Initiating a coverage on Carter's Incorporated with a hold recommendation and a 12-month target of $70.43, which is a 30.94% upside from the current price of $53.79 as of January 15th. Not saying Carter's is bad, it's just holding steady. Carter's is the king of baby clothes, with high customer loyalty and adorable onesies, and a strong reputation for quality and comfort, making it a go-to choice for parents. Retail isn't child's play. Carter's is growing in e-commerce and international, but still struggling with market saturation and fierce online competition. The retail landscape is evolving rapidly, and Carter's needs to innovate. They are financially strong, but not growing rapidly. Carter's is playing it safe, more like the responsible parent than the risk-taking entrepreneur. They have a conservative approach which ensures stability, but it limits its growth potential. Now let's talk about what makes Carter's the cool mom of children's clothing brand. Carter's blends style and functionality, offering a wide range of products and cater to different needs and preferences. From everyday essentials to special occasion outfits, Carter's has it all. The children's apparel market is growing, but Carter's isn't exactly skipping through the playground without a few scraped knees. Online shopping has become a habit. Parents are tired, they're stressed, and they're increasingly shopping online with their phones rather than the brick and mortar stores. Fast fashion brands like Shein and H&M are more widely known and established. They offer trendy, cheap baby clothes that parents rethink paying more of a premium that their kids are going to outgrow very shortly. Now let's hand it over to Nick Bennett, who will give us the lowdown on Carter's position in the baby clothes industry.
Carter's has several advantages in the baby clothes industry. First and foremost being their stores that are able to be walked into. They have over 800 on American soil, not including the partnerships they have with well-known brands such as Walmart, Target, Kohl's, and Amazon. On top of that, within their own ecosystem, they have 7 of their own brands that they're able to use to make certain materials, certain products that it doesn't infringe on their past products, or develop new things without letting consumers worry about where they're going with this new trend. Last and foremost, the biggest is their years of experience. They've been around for over 150 years now. They are experts in trends, sizing, parents, and of course, babies. They know what the consumers want, what the people want, and they provide it for everybody. Unfortunately, it's not all roses right now. Retail in this moment is a little hazy. Economic pressures are strong. Inflation is growing and growing, and although the government's working on it, we don't know where that's leading to. And when at the end of the day you're buying stuff, your paycheck speaks. So when your budgets are tightening, you buy cheaper things. So although Carter's is known for its quality and its product, that doesn't always mean people will buy it first if they can't afford it. Internationally, they've developed several markets. They have shops in Canada and Mexico, and they've established with already well-known brands in the Middle East and Asia. So they're selling everywhere now, but total revenue internationally is only 15%. The numbers are not high enough. They need to increase in this to get it where they need to be. And finally, e-commerce is a bright spot, but they are definitely not top of the market. This company was developed in 1865. That is literally the Civil War. They didn't know what online shopping was. They didn't know what online was. So they're playing catch up to all these companies that were developed with it in mind. They're getting better. They now have RFID technology for tracking, and they do same-day fulfillment with in-app purchases, but it's not their bread and butter. So they've got to develop on a lot of these things. Now, to take a look at the piggy bank in Carter's, let's hand it over to Angelina Bowden.
Thank you. Let's talk finances, or as parents like to call it, how much did we just spend on diapers? Carter's has 3 primary drivers of profitability: operational efficiency, higher margin product categories, and cost headwinds. Lean supply chain practices mitigate cost pressures, and growth in premium and private label products contribute positively to gross margins, while inflationary pressure on raw materials and logistics costs have moderated profit growth. Carter's is still growing, but not fast fast enough to impress investors. Conservative discretionary spending in key markets has led to annual revenue being relatively flat. EBITDA margins hover around 13.4%, but rising costs could turn that into a toddler tantrum. Carter's generates strong cash flow at 7.8% of revenue, but rising costs can. So rather than reinvesting in bold growth, Carter's focuses on shareholder returns, meaning more share buybacks and dividends than risk taking. We used a blended DCF and relative valuation approach, driving a 12-month price target of $70.43. Our relative valuation uses a forward price to earnings ratio of 11.5 times, applied to a 2025 earnings per share of $5.20, and an earnings value, an enterprise value to EBITDA ratio. We opted to use a free cash flow to the firm intrinsic valuation model due to historical volatility in Carter's capital structure. FCFE is more sensitive to variations in leverage, making FCFF a more comprehensive and stable measure of Carter's operating performance and cash generating ability. Additionally, we chose not to use the dividend discount model because of Carter's management's dividend payouts do not consistently correlate with their earnings. Additionally, Carter's uses retained earnings to finance growth initiatives and share buybacks, making dividends an incomplete representation of the value returned to shareholders. Now, let's take a look at Carter's report card. In order to compare Carter's to the rest of the class, we ran a peer comparison using ESG factors, because even baby brands need to think about their future. Carter's trades at a forward price to earnings ratio of 10.7 times, below the industry median of 13 times, suggesting potential upside. Now, let's hand it back over to Nick for the ESG analysis.
Carter's is a very transparent company when it comes to their ESG, so much so that they've set 5-year, 10-year, and 20-year goals that they want to establish so that their consumers can know what they're doing and how they're doing it. The 3 top ones right now being growing sustainable offerings, reducing carbon footprint, and uplifting workers and communities. The way they're doing this is through several opportunities, the main ones being reducing waste. Right now, their big goal is they want to reduce all virgin packaging for shipping by 50% by the year 2030. As of now, they've reduced it by 30%. The next goal, that they want to do is use all sustainable cotton and polyester fibers by 2030 in all their products. Right now, most of their products do this, but not all, so they want to shift it where everything is doing this. They also do a return products program where you can send in old Carter's clothing that they will either recycle humanely or reuse in new products. So in the grand scheme of things, they're trying to have no waste at this point. On top of reusing products, they also want to do partnership with nonprofits. They are working with 0 to 3 to support child development, Planet Water to supply water and water filtration system to communities in need, as well as donating over $2 million a year to communities that can't afford their own baby clothes or supplies. Within governments, the company is very transparent. All their board members, or majority at least, are independent, causing no conflict of interest, but their ownership is still family controlled, meaning they can't do shifts quickly. So although board members are very fluent, ownership is not, so it's a give and take there. So let's send it back to Brian for risk and shifts.
Demographic shifts show a long-term decline in birth rates. Carter's core market could shrink in the future. Inflation and cost pressures could squeeze margins further, especially with competition from low-cost rivals. Carter's announced the next CEO will be external, introducing uncertainty around leadership, direction, and strategic continuity. This could impact investors' confidence and execution in long-term initiatives. Carter's is a responsible parent of children's apparel, steady, reliable, but not exactly setting the world on fire. Tough retail conditions and trying to stay trendy without losing their core base, they are playing it safe rather than making big moves. CRI presents stable investment options and strong cash flow generation and a reliable dividend. However, near-term challenges include declining retail traffic, margin pressures, and leadership transitions, while international expansion and e-commerce growth provide long-term opportunities. That's why we're giving it a hold recommendation. Carters may still be growing, but right now it's more like nap time than recess.
Time.
And now we open it up for questions.
I'll kick it off. What with the importance of the online segments, do they offer free returns, or how do they compare with other online retailers? Have you all looked into that?
Nick, have you looked into any
I
of
think
the?
that's me, yeah. Trying to find the slide. They do offer free returns, but only in store, so you can't ship it back. If you do try to ship it back, they ask you to pay for it. But there's so many stores, and they partner with Kohl's, you can do returns there. So they do several things to make it easier for people to do returns. They also do really well with the returns that they receive. They check them for quality. If they're good, they wash and put it back in the market, or they donate it to a system that someone else can use it.
So if I heard it right, it's not, if I ordered online and I wanted to return it, I'd have to pay for the shipping, or is that the way it works?
If it's unopened, you can return it at a store. If you would like to ship it back, you would have to pay for it. Got it.
I'd like to explore your recommendation of hold a little more. When you did this, and at least one of the slides had a price of 53, but a 12-month target of 70, which is about a 30% increase. And we all know that the stock today is lower, 41. I don't really understand why it's not a buy. And number two, I think I heard that the dividend is reliable. I'm not totally sure that that's true, considering the likely payout ratio in 2025. But again, why is it a hold, especially at today's price, compared to your upside target and the yield?
Yeah, great question. We actually indicated that the dividend was not reliable, so we did not include that in our valuation. And we chose to have a hold valuation because we think that the challenges offset the growth potential of the company. So, for example, their lack of revenue growth and, like you said, their payout ratio indicate that even though they are growing, it is at a slow rate. So we want to account for those risks in order to mitigate any potential losses for investors. So would you like to expand on this, Brian?
Yeah, and one of the things that we noticed, I mean, when we actually did the evaluation, the stock was trending, and it was actually increasing coming out of the Christmas shopping. So many of the Carters shows their highest gains in the fourth quarter. As we were seeing, or as we started this, we even talked about it with the CEO, deciding that he was stepping down. It looks like that it is a shift in the other direction, but we had to go with what we had already stuck with and what we had projected, from the start.
Can you talk about potential tariffs and how they may affect the company?
Yeah, we accounted for rising costs, especially with our raw materials that come from overseas, especially sourced in Southeast Asia. And so with rising tariffs, we do expect that margin pressures may increase. And so that is another risk that lends to our hold recommendation rather than a buy.
What are the other assumptions that went into your DCF?
Yeah, if you could turn to the valuation assumptions, please. Yeah, so we used an assumed negative 8% growth rate, which is actually optimistic compared to the 22-day moving average. As you can see, it's negative 9.84%. And we used a weighted average cost of capital of 7.3% with a leverage beta of 1.24. And we assumed a 0% terminal growth rate because of the mature industry and slow growth in the last 5 years or so. So our valuation is actually very conservative.
I guess I'm a
with
little
base
bit
case.
confused. If free
Yeah.
cash flow is falling, how are you getting a 30% higher stock price than the current price?
Yeah, so,
Like, what are your other assumptions that went into this besides the free cash flow growth?
so if you could go back to our absolute valuation slide, please, on 38. Yeah, so we did project free cash flows, and they're still growing, just not at a high rate, and so that lends to a greater output. Would you like to expand on this, Brian?
Yeah, I mean, it was kind of hard, especially on the cash flow, because in 2022, they had large amount of stock and they just went ahead and paid for it. And then in 2023, they had already had stock that was already paid for, and so the numbers showed a 400% increase in revenue. So
Yeah, so prior to 2022, there was a slight negative decrease in free cash flows, and then, like you said, a 400% increase. So we had to, account for that extreme outlier.
In one of your slides, you had, when you're talking about margin, you're showing the SG&A as percent of sales, it's keep increasing. Do you know why is that happening? When you presented it was, one of the slides were showing gross margin and also SG&A as percent of sales.
Yeah, okay. Could we see the higher margin product categories, or perhaps operational efficiency?
This one, yep.
Yeah.
So you see the orange line, SG&A is as percent of sales, it's
Yes.
keep increasing.
Yeah, so our cost of goods sold has experienced a minor decrease, but the SG&A has increased, and we can only presume that that would be because of their recent marketing initiatives with the More Than Cute campaign, as well as having to, they remodeled stores, and I'd imagine had to market for new store openings that came, as well as closing in low foot traffic areas.
And how does their operating margin compares to competitors?
Yeah, so they, could we see the peer comparison, see if that is there? Well, compared to very similar competitors, such as the Children's Place, they do have a higher operating margin. But then when we're talking about Nike and H&M, they do lag behind. So direct competitors in only children's apparel, they have the #1 market share, they have higher operating revenues.
How do you feel about the stock repurchasing that the company has done in recent years?
So as far as the stock repurchasing goes, I believe that is going to have especially considering that there hasn't been much activity with this stock as far as buying, I think that is going to return more value to existing shareholders.
What is your take on the departure of the CEO, which was really earlier than a normal retirement would be? Do you feel like the independent directors perhaps pushed him a little, or he was just disappointed with the results and felt like he needed to make room for somebody else?
Well, I'd like for you guys to expand on this. However, my take is that their current strategy, as we've said, it's family oriented, very slow growth, and so they're looking to externally source another CEO. I think in the future they would like to redirect their strategy towards higher growth and maybe penetrating new markets such as international expansion and expanding their online capabilities.
And I agree, but I think that a fresher look on things would benefit the company as well. You know, a lot of their goods are imported, and so with the tariffs, we don't know where they stand coming forth. So do you bring a lot of the stuff manufactured inside the United States? So having a different look on different things like that, I'm sure is what I would say. I think he probably stepped down or took a step back on his own. From what I understand, could be wrong, but I think he's still going to play a key role in who is selected as the next CEO. So yeah, I think he just was stepping back to get a fresher look from a different set of eyes.
Yes.
Last question.
Did I may have misinterpreted one of the slides that said family ownership. Is there some concentration in who owns the stock? Or is it diverse, is it held widely by folks?
There's among
Family controlled, yeah.
Yeah, it is family controlled, and as far as the ownership goes, the directors, which do include some of the Carter's family who originally started the business, do own, I believe, something like 10 to 20%,